What's going on, guys? Welcome to the Venture Coiners podcast, the podcast for crypto traders and investors. Today, I'm having a conversation with David Belle, macro trader and author of the Macrodesiac newsletter. We break into a ton of topics, and this is for FX and legacy market traders as well as crypto traders. We look at the relationships between those assets, trying to approach the trading game from a longer term perspective and how that's helped him. It's something that I believe in completely, as that's really the way that I approach crypto as well. We also look at trading news events, and maybe not necessarily trading right at the news event, but using that news and that narrative to maybe build into your position or to trade in the tails, as David says. He has some insights and perspectives that I've never heard any other trader have. Right, following him and his research, I think will give you new perspectives or things that you can add to your own game. So I do believe this podcast, this conversation is going to add a lot of value to you. I hope it does. If it does, and if you appreciate this content, please reach out on Twitter, comment down below. I'll be sure to thank you personally if you reach out on Twitter. Always like hearing from you guys. Be sure to subscribe down here in the bottom right-hand corner so you get updates every single time I go live. We'll also be doing some live podcasts, so if you subscribe, you can get your questions answered live from my next guest. And without further ado, let's get into it. Roll the tape. What's up, guys? I am very, very excited to bring you this podcast. This is going to be a conversation with David Belle, a macro trader who's definitely going to have a different perspective on what's happening in crypto and also what's happening in legacy markets and as that relates to crypto, which will hopefully provide value to you, whether you're focused on those markets or crypto specifically. This is going to give you kind of a new perspective or maybe a new way to think about things. Conversation is going to be a lot of fun. We have so much to cover. Before we do that, though, I'm going to let David kind of explain his background. David, I think that's probably the best way to proceed is if you could tell me and tell everyone else how you got to where you are today, what you're doing today, and kind of exactly how you would describe any of that.
Yeah, perfect. No, Luke, cheers for having me on. I'm excited to do this. But yeah, I basically started out with interest in economics probably when I was about just after the financial crisis, going into doing sixth form or the later years of high school. When you go to do A-levels over here, I chose to do economics. And obviously at that time, the economy was at the forefront of everyone's mouths and they were all thinking about it and it's in the news all the time. And I was like, oh, I kind of want to, understand more about this thing that is trending so much and, what people are talking about. So I started off there. I had no real understanding of what an interest rate was, what the stock market really was before then. And really, it just kind of grew for me into, as I was studying for my A-levels, you have YouTube searches when you're maybe looking at, what is the stock market or whatever. And then you get, the personalized advert recommendations. And I think my first trading account, one of these adverts popped up. And I think it was Trading 212, which was my first ever account. So I clicked this, opened up a demo account. This was when I was just before I was 18, I think, which I think with a demo account, that's not illegal to open up a trading account.
Yeah.
But started off there, made, $1 million on fake money really quickly, thought I was great. Put my own money in about 3-4 days later, I kind of lost it all. And, going through university, I went to study economics as well. It was quite a common theme for about 3 years. I didn't make money for 3 years because I just, I was changing strategies and doing loads of stuff. And I just didn't put the work in for, about 1.5 to 2 years. But then in the third to, I don't know, fourth year, that's kind of when it clicked. And I knew that there are certain things that you can do to increase your edge and certain things that will always deplete your edge no matter what you do. After that, I went and worked at a brokerage because I wanted to know the other side of the market. I wanted to know the sell side. And from there, over the few years after that, I was just trading the whole time. I take a longer term approach on things. I used to be day trading all the time, and I was honestly shit at it. I would have really good runs for 2-3 months, and then for 4 months I would lose money. Sometimes, I would literally not make any money for ages. But the times where I was trading on a longer time frame and using macro ideas, that's really where I saw that I had a higher success rate. and I was comfortable with risking and pyramiding into the market and pyramiding out. So that's really where I am now. I went and worked at a brokerage for a short period last year, and now I'm back just doing my own thing again, which is brilliant.
Very cool.
I prefer it way more.
Yeah, very cool. The wide open schedule is obviously nice for the trading and the research side of things as well. Before we get into the macro view and kind of the way that you view and approach the market that I think is going to provide value to so many of the listeners is one thing I actually want to bring up in what you just said, and it's the way that I started as well. It's the way most people start. Is they start with a demo account, and then you'll kind of upgrade obviously to your first trading account. And I think one thing, I don't think a lot of people will say this, and I think you're going to be fine with and fair with being completely honest as well, is a lot of people won't admit this, but when I funded at least my first trading account, trading FX after the demo account, it took me at least blowing an account. I actually think blowing an account was incredibly beneficial for me to kind of understand that, like you had that experience with the demo account of, you made $1 million, you're a genius. There's no real development of an edge. There's no real kind of meticulous, paying attention to risk management, things like that, staying consistent, being systematic. Blowing an account for me was massive. Yeah. Do you have a similar experience like that, or kind of talk about how that transition from a demo account to a real account change things?
Yeah, no, absolutely. I think with a demo account, especially, it's almost like confirmation bias. I probably blew a few demo accounts as well, but the one that I remember is running it up 1,000%, because that's when you think that you're an excellent trader and you've cracked it, when you haven't at all. But yeah, I absolutely think that it is one of those cliches where failure breeds success almost. It's almost like if you hear about entrepreneurs who are really successful, they've probably had about, I don't know, 4 or 5 ventures before they hit the real big time.
At least, yeah.
But the issue with trading is that it's one of those things where even if you do persevere, you won't necessarily make it, which it and it is one of those things where if you do realize it's not for you, it's better to cut your losses pretty quickly.
Mm-hmm.
But at the same time, if you don't persevere, you don't know if you're not good at it.
Exactly.
So
Yeah.
yeah, it's a really, really tough game. But I think as long as you do have a specific discipline and the desire to learn and have some emotional intelligence, I think is really important. Then you will always give yourself an edge over the rest of the market,
Yep.
because a lot of people just refuse to do that.
Yep. Yep. Certainly. So one thing before we dive into, you building your edge and you focusing on macro, I think that's such a crucial thing that I also believe in. But before we kind of get into, how FX relationships and between that and legacy markets and thinking about risk on versus risk off, one thing that relates to also the crypto market and for newer traders that are people getting in, and you see this across Twitter all the time, is this constant battle of what should I be focusing on, technicals or should I be focusing on fundamentals? And one thing you've talked about is understanding the why factor, or understanding the fundamental drivers of the market, and how that can lead to really, I guess, being supplementary. If you are a technical trader, or if you're not a technical trader, that should really be kind of developing your thesis or developing your bias in the market. Can you talk a little bit about why understanding the fundamentals or the why factor is so important?
Yeah, absolutely. I mean, I'd argue that in legacy markets, if you want to call them that, they already have a very, very clear use case. Let's take FX for example. Okay, people use money. $5.6 trillion is transacted every single day in the FX markets, which is huge. It's a huge, huge amount. To finance things, people have to do these transactions cross border and whatnot. So you have to realize then that if people are looking to buy assets in a specific country because they perceive that country to be of a better standing than another one, for example, okay, that has a clear effect. Now, what technicals will not kind of show you is those longer term flows, because a lot of people aren't just looking at the intraday noise; they are looking at the bigger picture. Especially if you do have, a lot of money to be playing with, and you're looking at long term investments. If you're, a wealth manager or a hedge fund for your clients, you don't really want that high intraday risk. You want more of a longer term picture. Um, So that's where I think, but I think also you do need to combine the two. I still combine the two. However, my thesis of directional plays is always going to be based on the bigger macro picture. Entries and actual execution tends to be based more on the technical side. However, I still place more emphasis on the macro picture, because, as I said, that's what drives the flows in the legacy markets. In crypto, I do believe that at the moment, technicals still drive the market because there's not necessarily the same issues occurring in or I'll say issues, the same events occurring in Bitcoin, for example, as would occur in a fiat currency. Um, in terms of interest rate decisions and that kind of thing. So I think a lot of traders in crypto are focused more on the technical side, because there's honestly there's not as much going on to be able to drive a fundamental opinion.
Yeah, and the driver word's so important there. So that's actually what I was going to ask you next is, when people look at breakouts in crypto, suppose the Bitcoin move we just had in the last month, obviously for any move, and I guess this also goes for FX or stocks or whatever you're trading, there's always a narrative that can be attached in hindsight, right? I can say that this recent move, Bloomberg was saying this recent move was caused by JP Morgan coin. Obviously, that's a ridiculous narrative to assign a positive move to the Bitcoin, but that's one of those fundamental things you can tie onto a price move. Or a technical trader on Twitter will look and they'll say, no, that's Bitcoin price breaking above yearly open at 3,700. That's why it jumped. And sometimes, I believe it's probably a combination of the two, and 2 plus 2 might not equal 4 there, right? It's not always going to be a technical plus a fundamental kind of working out. Sometimes there's something else happening in the market. It could just be someone chasing momentum that also adds in. So you really do think that technicals can actually kind of be a driver in a crypto market that might lack some fundamentals? Do you think that's true? Like if there is just, even if it's just psychological, suppose a resistance, do you think technicals are maybe playing a bigger role in driving the market than fundamentals?
I'd argue in crypto, yes, but it's one of these things you spoke about, applying a narrative to things. Let's talk about that JPM coin, for example. Um, these narratives are created by journalists. They're not created by people, and this is actually one part of how I form a view as well. They're not created by people who are involved in the market, and this is why they're journalists. You know, you won't see amazing research on the front page of Bloomberg, for the simple reason that it's there to have clicks driven to it.
Yep.
Okay, you're not going to hear about really premium content that, firstly, I just don't think it exists in the specific realm. JPM coin isn't going to cause a rally in Bitcoin, let's put it that way. Okay, if anything, it'll probably do the opposite, as many other people were saying. They were saying that, oh, it could replace Bitcoin. So why is that narrative not pushed forward as well, if 50% think that and 50% think it's positive for it? So yeah, you're absolutely right. You can apply a narrative to whatever you want, and the issue is that I think that if you are trading purely technicals, it's better to understand your statistical edge, because then you can be totally agnostic to any kind of narrative, and also that means it reduces kind of paranoia, it reduces anticipation of moves. You just trade what you see, and if you're confident over a large sample size that there's little standard deviation possibly from what your potential profit outcome could be, or whatever your expectancy is. It's all about just reducing these emotions in a market that is as volatile as Bitcoin. And to be honest, I don't see a huge amount of testing occurring in the crypto markets. I see people calling moves, but I don't see them saying, "Oh, this is my statistical edge over 500 trades," for example, or even 100 trades if you want to use a different confidence interval. Um, but yeah, that's just my take on the kind of technicals versus fundamentals thing. But obviously, in the legacy markets, it is different,
Yep.
because it's much larger, and it's not as infant. It's not an infant market, or most of them aren't infant markets.
Yep. Yep. Definitely. It's kind of, I guess the best way that I try to put it is, fundamentals are kind of the reason, and you said it, the reason why, or the driver, and then the technicals are going to kind of help you with that entry or exit thing. So I definitely want to
Yeah.
hit on that. That's something a lot of people on crypto like to debate, the technical versus fundamental. It kind of makes me laugh to consider that someone wouldn't be at least considering both. Looking
Yeah.
at a different part of fundamental and how a technical trader could add this to the game, there's something that it really goes along with your more macro approach and more long-term approach for trading. But as it relates to news, one thing that newer traders, and this was something that when I first got in FX, immediately, the most attractive, or for some reason, it's appealing to try to trade news events, right? So if there's a rate decision coming out for the dollar, and you're trying to guess what Janet Yellen's going to say, or whether there's going to be a rate increase, or whether, they're hawkish or whatever it is, for some reason that's appealing, and usually it's because it's going to drive volatility. I think the same thing happens on the crypto side of things. People get excited when there's new news that comes out about Bitcoin, or an ETF, or some decision comes out, and people are kind of thinking, it's a 50-50 bet. If I can position long, then I'll hit it. If I position short, then I'll crush it. Obviously, it doesn't always work out that way. There's whipsaws, spreads can increase. I generally try to avoid trading news events like that. But you had a tweet talking about a different approach of playing news that's kind of longer term. Can you talk a little bit about how a trader could maybe add that fundamental part of the game to maybe what they're doing technical, and not so much just trading right when the news comes out, but kind of adding those news pieces to the narrative?
Yeah, sure. So my whole framework of creating trade ideas is based on the idea that you should always be trading in the tails. So if you consider a bell curve shows, the normal distribution, and then standard deviations away from that normal distribution. So what I look to do is to match up data that is currently not fitting the narrative. I'll give you an example. So this is one that I've mentioned quite a lot about Italy.
Mm.
So for a few months, everyone was speaking about Italy, and you saw the Italian government bond yield spiking, obviously showing that there was risk occurring, and um, that they were in a sorry state essentially. However, my whole thing was that we know now that Italy is kind of fucked, right? If you looked at the data of France at that time, okay, French banks held the most exposure in the whole world to Italy, okay, but that wasn't being spoken about. You also had the 3% deficit spending limit that France were at. A few weeks later, the yellow jackets started, okay. So that's what I mean by playing in the tails. You want to be right at the far ends of a normal distribution, where the data isn't currently matching the narrative, or sorry, the narrative isn't matching the data, is probably a better way to put it, in fact. Where it's really, really obvious that something is occurring, where the direction should go, but it's not there yet. The,
Mm.
the market hasn't moved. Um, and one of the trades that I'm kind of using to exploit that is staying short euro pound, because it's the cheapest way to get in the market, and it's the easiest to get out of it as well. Um, and talking further about that news trade in the news, I think what I was referring to is more the news flow. So when you have that initial positioning, how that news flow can then push the direction in your favor. So if we then go further and we start talking about Germany, for example, on that specific trade, German industrial production has been going down heavily. You know, we're getting now a follow through where there was a recession risk there. They managed to, not go into recession, but it was at 0%.
Mm.
Previous quarter was at minus 0.2%. So it's all these little things that you just add together to piece by piece, to kind of create a jigsaw of what the story could be, and then you execute based on your levels where you think the market is overextended, and that there's likely to be a whip back, or when everyone's piled in a certain direction and you want to take it the other way because the narrative, or sorry, the data isn't currently meeting the narrative.
That makes sense. So I think that pyramiding is a word they used at the very beginning that kind of makes the most sense to me in that regards, is not necessarily trading, exactly when that German data comes out. But if you're positioned already into that and that supports your narrative, either adding on to the trade at a technical level that made sense, or kind of as that narrative gets closer to kind of being aligned with what you think your edge is, maybe scaling out. So it's kind of like,
That's exactly.
yeah, cool. I want to touch on that because I know there's just so many people that are still focused short term on trading news as opposed to kind of using it as more of a guide on whether to be leaning into their trade versus out of it, and just kind of using it that way. So you had a unique view on that I wanted to bring up. Now talking about still on the lines of approaching things with a longer term and a more macro view, and this is something I've tried so hard to bring into crypto. I think it guides really all my decision making in crypto, but I don't think a lot of people understand this approach unless you do come from FX or a market where you're trying to understand geopolitical events and whether risk on helps the dollar and hurts other pairs, things like that. But why do you think you had a tweet? There was actually a trader on Twitter who blew up an account, and they were doing some ridiculous short-term trading, piling on risk, very intraday moves, very complicated stuff, a lot of in and out. You talked a little bit about, and at the very beginning, and you tweeted this, that really the thing that worked for you the most was trying to play the longer term game or the macro game. And I think that's really the only way that the average retailer or trader has an edge in crypto. Can you talk a little bit about why it makes sense, or you believe it makes sense for people to be focused long term on the macro game as opposed to kind of day trading in and out?
Yeah, sure. So there's actually a paper on this, and I don't really want to dwell too much on high frequency trading or anything like that, because honestly, I don't know enough about it. But the paper actually said that the only participants in the market that the HFTs don't profit from are those that are longer term fundamentals based and other HFTs. So if you're intraday, your edge is being diminished by these people that have extra low latency, that can lift the offer really, really quickly and just keep just kind of pecking away at what you're doing intraday. If you're longer term, you don't get that same issue, because you can have greater variance in price on your position. You can have more comfort with where you do want to get into the market because you trade a bigger range initially, for example. But I can send you this paper, and you can give it or put it in the comments on this podcast after. But yeah, that was essentially it. And I think that you have to realize that if you are trading intraday, most of it is noise, because in FX, for example, most of what happens intraday is just client orders from people actually using FX to send money and stuff. There is obviously a load of speculation as well, but a heavy amount of it is just agency business. And it's just one of those things where you have to realize that there's way more going on in the longer term that you can actually take an objective view on. Whereas intraday noise, you can't be too objective. You're really just guessing whether, price might run these stops, or, price will do whatever you think it might do. So there's only really one way that you can get around it if you are intraday trading, and that is to know your edge and exploit your edge as much as possible. And when your edge is kind of diminishing, to trade with less risk. And when you really are killing it, just absolutely milk it and go full risk, because you only, as I said, I used to only make money sometimes, 2-3 months, every other 2-3 months. So in those 2-3 months, I really had to risk up. And then when it was going like crap, just risk down, because I just, it starts to eat away at you sometimes if you're consistently losing, maybe week on week, month on month or something. And you just don't want that.
Yeah. Can you dive in and just give kind of a concrete example of what that would look like for crypto? I know you described it for FX, but just to really drive home, because it's the approach. It's the same way that I think about crypto. I think a lot of people, it's almost glorified as well, whether it's social media or I don't know what creates the idea. Maybe it's the movies or people's just vision in their head of sitting there and day trading or clicking buy and sell, like literally market buying and selling on the screen. And that's, at least for me, that's really never what's generated my returns. If I look back, it's very similar to you. It's kind of a longer term play. If there's any one trade that kind of really made it for me. It's always kind of been a longer term. I was able to allocate more to alts, or I was able to, be heavier in Bitcoin, and then for that rally and kind of scale out when it made sense. I think that I would attribute a lot more of my success to, as opposed to intraday stuff. Can you dive in a little bit deeper at what concrete that would look like for a crypto trader or crypto investor?
So it's all about understanding what your edge is. And that can only come through statistical testing and literally writing down the things that make you win. So it could be that you trade on a Tuesday afternoon between, I don't know, 1 p.m. and 3 p.m. If that's where the bulk of your profits have come from over time, because you've tested it, you've recorded everything, and you know exactly which crypto asset you're making the most money in. It might be Ethereum, it could be Bitcoin, whatever, it doesn't matter. Then just trade that, because that is your edge right there. You've got an objective edge there. But then if I guess some people might go and trade on a Friday, and that's where they lose the most. So stop trading on a Friday, okay, and trade on a Tuesday between those times, because that's where you're making money. You know, the other thing as well is that people complain about BitMEX and the price spikes and all of that kind of thing. Well,
Yep.
stop fucking trading on BitMEX then. It's not about having access to everything. It's about knowing your edge, okay, and exploiting your edge over time with minimal downside. It's not it's difficult to do, but it's not difficult to understand. And I think most people do understand that they do need to do these things, but they get so emotional about it and they just don't want to do it. Um, because the opportunity, and but to be fair, it is like anything, so I can't be too harsh on people. But yeah, just understand. And if you realize that BitMEX is spiking you out, for example, or fucking you over all the time, stop trading on it. Stop giving them your money. It's
Yeah.
easy as, because you're not helping yourself. You're not helping yourself. But yeah, that's my small rant over.
All right, cool. No, it's an important one. I think also BitMEX and that style of trading has gained more notoriety because we've been in a bear market, and the people that got into crypto and probably made a nice chunk of change in 2017 was just because I think people thought they were trading, but really what was happening was you could kind of trade and then just pray and hold on for another 2 weeks and things would go up and to the right. So now kind of
Yeah,
once that theme has stopped, that's really been the only way that people are getting any kind of crypto action. So I think that's
yeah,
I'm really glad you brought that up because
sure. But
it continues to get put on a lot of retail traders. Adding leverage to the game when you're already new and you're trading crypto is probably not the best solution or formula there.
yeah, I mean, leverage is kind of that yin and yang thing where you really need it, but it can also really ruin you as well. Especially in low liquid environments where your stop could get run really easily, or you're just not filled. Um, but yeah, no, it's a tough one. But talking about the kind of change in the crypto markets as well, I think you have to learn to adapt if you want to be long term in this game. You have to be able to trade your strategy when it's right for you, but you also need to be able to flip as well. And I see the word bias come up a lot on Twitter, and I just don't agree with it. You can't have a bias. You have to be able to change your view like that if you want to be a trader. And if you don't, you'll get stuck in a position, and you'll eventually just keep trying to almost martingale out of your position to try and make money, and it just doesn't work. It doesn't work.
Yep. Um, moving along with pardon me, moving along with staying partially with crypto, but getting back to more FX and traditional markets and the bulk of your research, you spend, and tell me if I'm wrong, I believe a lot of your focus is kind of understanding for yourself and then also communicating your research to people of what the cause is of an event and then the effect, right? So, if there is a risk on environment, then this happens to maybe, X, X, and X, global equities or the dollar or commodities and things like that. That's something that doesn't get talked about a lot in crypto, but the one thing that does get talked about is there a relationship between legacy markets and crypto? I'd be curious to hear your view on, could global equities be moving down in a risk-off environment and crypto does well? Is crypto insulated from all the other, macro things happening in the world? And if it is, why?
So I actually wrote to subscribers of my newsletter about this. I think it was just last week, and what I mentioned was that there's a dollar illiquidity problem at the moment, where the global monetary base for the dollar is retracted by about 7%, roughly 7%. Now, if you've got to really consider that there's not just Bitcoin in the equation. It's always counter traded by something else, and generally that's the dollar, right? So um, every single time that the dollar liquidity has decreased, Bitcoin has gone down, and that's not price dependent. That's just purely a liquidity play. Now, the Fed have just recently mentioned about kind of easing again or keeping QE going, essentially. And what that will do is actually that, in my view, that will provide liquidity to the dollar again, because the conditions for tightening will kind of have ceased. There's a measure that you could look at called LIBOR, which is the London Interbank Overnight Rate, and that essentially shows what the cost of lending between banks, the cost of short-term lending between financial institutions, and right now it's really high because obviously I'm talking for US dollar LIBOR here. It's really high because the Fed have been tightening for the last 2 years, and also they've been decreasing their balance sheet. I personally think that when the dollar liquidity starts to get positive again, that's when we'll see the Bitcoin bull run. You can actually look at LIBOR as a measure. I think they've got it on Trading View, or you can just look at the Fed funds rate. They follow each other, or euro dollars. Um, but that is my thesis. And you spoke about risk on and off, and I think they're slightly connected in that sense because if we do go in a pure risk off market, then the Fed will have to ease, and global central banks will be forced to ease further. And
Mm.
obviously, that will alleviate the dollar liquidity problem that we've been having recently. So yes, they are linked in that sense. Possibly there is another issue at play here, which is that there there is no real risk-free rate of return really. That means that there's no real safety for people to pile into. So they do go on an aggressive hunt for yield. Now, when that interest rate does decrease again, my view is that Bitcoin will become um, a bullish market again, longer term, because people are just simply going to want to look for that high alpha move. It's like people piling into small cap stocks. They have their main portfolio, which might be made up of, I don't know, SPY or larger cap equities, but they also want a small portfolio of maybe 5 to 10% that is made up of high alpha stocks, which could move, I don't know, 100, 200% in a few weeks, which is very similar to what crypto does a lot of the time. So yeah, they are linked. However, not in the ways that I think people think they're truly linked.
Having a little bit of fun with this. If let's say that Bitcoin bull run doesn't come, or dollar liquidity doesn't increase, and let's say it is a risk off for stocks, right? S&P continues to sink, or this turns out to be a dead cat, whatever it is. Do you think that right now, not thinking in the future, right now, would crypto as one of the highest risk assets? Do you think it could perform well if S&P and global equities perform terribly?
Um, yes, however, the S&P and global equities will only start performing terribly if people lose total confidence in the central banks to provide liquidity. The only reason we've seen this rally recently is because the PBOC, the People's Bank of China, provided the largest 1 month liquidity injection pretty much ever. On January the 16th, they injected $89 billion in one day, which is absolutely fucking ridiculous. But that's what their game is now. And
Mm-hmm.
if you look at price to equity valuations, okay, and the data coming out in terms on Friday, for example, we just had US manufacturing. I think it was the Philly Fed manufacturing PMI that came out at minus 4.1, I think it was. So you're seeing US manufacturing contracting, yet the S&P went up. Why? How? That makes no sense whatsoever. And it's purely because it's financial engineering from central banks.
Mm-hmm.
It's a fake market. And
It's an
it sounds really
experiment.
kind of, yeah, it's literally an experiment, and it's all going to go wrong. It's all going to go wrong. And when it does go wrong, it's going to be absolutely horrible. Um, but, you know, it's difficult to put a time frame on when it will go wrong, because they're just up to these weird, as you say, experiments with just injecting money and interest rate manipulation, and it's just crazy. Um, but 2800 could get run and we just dump but on the
Hmm.
S&P. But just don't know, honestly. I'm sick to death of it.
That's fair. It's unique in that I think equities, at least of late, have almost been as interesting to follow, not as volatile, but almost as volatile as crypto, which is nice if you're a trader right now. Um,
Yeah, yeah.
Thinking about, I was going to ask you one other question with kind of legacy markets, if, like I said, if we can call them that. Gold trades as an inflation hedge, and I would say it's probably a clearer linkage. If something geopolitical happens or something happens in terms of interest rate yield and different things like that, gold is going to be. I think you can draw a more direct linkage to what would happen to the gold price as compared to Bitcoin's right now, right? I think we both agree there probably is a relationship there, but I think the news is still pretty inefficient with crypto. Sometimes it doesn't react maybe as it should. Do you think if Bitcoin gets more established going forward and does kind of take a bigger role as being this store of value that everyone wants to see it become, do you think it would act as kind of an inflation hedge trade, very similar to gold? Would it play a similar role in the economy?
um yes, possibly, if the futures market for Bitcoin were to be more accessible, I'd say. Obviously, you've got, I think it's is it Deribit?
Yep.
I think that's an exchange that offers futures and options on it. um but see, the main markets that are accessed by the people with bigger cash, I'd say, who aren't looking to trade spot or with specific leverage that you can do with smaller amounts of money. Because Bitcoin futures are cash settled, it's quite attractive to them because they'll never ever take delivery of it.
Yep.
So unless those margin requirements are decreased massively, um, I wouldn't yet say that that would be a possibility. But obviously, it's likely to become one,
Mhm.
if these institutions have, you know, um, easier availability per contract to the market, if it's cheaper for them to do so, and also if they have the specific infrastructure to do it as well. But I honestly don't know, and I wouldn't be certain to say anything that in terms of it being similar to gold in that fashion.
Okay, that's fair. One thing that I want to pick on in terms of and you're going to have a very I think this is going to be a really good concept I want to break down because you do very well at kind of explaining complex relationships or complex things happening in the market and breaking it down into terms that people can understand. And there's this, I guess you could say, myth that's propagated through Twitter. And I'm glad you brought up Deribit because it happens with Deribit, it happens with BitMEX, it happens with Binance. There's this myth that's going on Twitter. I don't know if it started on Twitter, but it's definitely there, where people think market makers are the reason a price dumped. Right? I already saw a tweet this morning of market makers dumped the price. Can you talk a little bit about what the role of a market maker is and why they're price neutral and why that narrative maybe doesn't make so much sense?
Well, so all the market maker is looking to do, sorry, is to take the bid and ask spread. Um, they're looking to provide liquidity, and this thing of, that ICT fella who's a total nutcase. He talks about a market maker model. It's total nonsense. It's absolute rubbish, and it just makes no sense in the context of a market because they want to be delta neutral. So if they finish the day with a float, which is whatever their positions are on their book, that isn't close to delta neutral, if not delta neutral, then they're holding risk. Market makers don't want to hold too much risk. Sometimes they'll go for a position, they'll try and run a position, of course, but it won't be, holding a long term position or looking to start building positions or anything like that. They literally just want to get rid of their float so they can make the bid and ask spread. That's all they want to do constantly. and provide liquidity to the market. Because if they're not providing an efficient market, then they're not doing their jobs, and they'll end up getting fucked over. So this whole thing about market makers dumping is nonsense. One issue that it could be, of course, is that there are a lot of algorithmic market making bots, or programs that are running. Now, the issue with these bots is that they are operating on a small time frame, similar to HFTs. And what that provides is something called excess kurtosis, or negative excess kurtosis, which means that um, if the market does start to tank, then it really, really goes, because they don't step in to provide any liquidity. And that's exactly the difference. So, but these are liquidity takers, really. They're not liquidity makers or providers. And that's an issue as well that's happening in legacy markets, where there was a yen flash crash back in January, I think, the start of Jan, and a lot of that was probably due to excess kurtosis, where there's no real human actors in the market, so there's no one to step in to provide liquidity when it's required. And possibly that is an issue that is happening in Bitcoin, because it's pretty liquid now. So massive drops like that out of absolutely nowhere possibly shouldn't be occurring. But also, it could just be people that just want to get rid of stuff. They just want to dump their position all at the same time. But it's not some massive conspiracy that market makers are doing anything against you on a grand scale. It's just nonsense.
Yeah, I already had a few in my mentions this morning when we were looking at Bitcoin stopping at a very clear technical level as well, 4120 or 4200, and then moving down. Obviously, I didn't expect, and I don't think a lot of people expected 10% down in a day. But I don't know why the first reaction is generally to assume that it's the market maker or it's the exchange. I see all the time people are saying it's Arthur running my stops, but you communicated that clearly. Can you just go one step deeper on why it wouldn't make sense for a market maker or liquidity provider to be long or to be trying to build a short position that exposes them to risks that they just don't want? Can you just touch on that a tiny bit more?
Yeah, because that's just purely not their job. They're not there to be looking at a long term play. They'll have a directional view, obviously, but their job is to make money on the bid and ask. It's not there to make money on here I'll short here and I'll take profit here. That's not what they do. They are constantly providing liquidity to the market via either limit orders or whatever. They're not there to be taking massive directional bets in the same way that someone sitting at home on their laptop would be.
on
But
their
yeah,
laptop with the tinfoil hat.
that's it exactly. But it's good that people do wonder about these things, because um, there's so many different components to finance in general. And by people wondering about these things and asking questions, and being genuinely interested, but from a perspective of a different asset class, it just creates different views and opinions altogether, which can only lead to a better and more efficient market anyway.
Yep.
And that's cross discipline. So whether you're in crypto or in the older markets.
Yep. That's one of the things I've loved about crypto is it's gotten, you mentioned it, a lot of people involved about finance and about these topics and asking things whether or not their intuition is wrong. It's getting people asking those questions, thinking about these things, learning about these things, probably when they wouldn't have been excited about learning about this as it relates to FX or as it relates to gold or as it relates to equity. So I do like that aspect of crypto. Thinking about that for newer traders that are asking these questions, or for even a passive investor, let's say, that's getting into crypto, there's been an interesting debate going on of, is crypto an easier table or is FX an easier table? And as crypto's been in a bear market, I've seen a lot of people say, you know what, I'm going to start trading FX. What are your views on that? Because you've had a lot of experience with both, and I know you spend a little bit more time with FX in those markets. Is crypto an easier table? I would kind of argue that it is. What do you think about that for other investors and traders?
I'd say that it has been, because all you have to do is look at a chart of it over the last 2 or so years. It's probably been very hard not to make money over what I think there was 8 months in 2017 or so. If you lost money in that market, then you're just probably shit and shouldn't trade whatsoever. But at the same time, you've got to remember that when you're trading, you're up against some of the smartest people in the world, but you're also up against yourself. So I wouldn't say that either are really easier or harder than the other, which is also why you do have to give a break to people on Twitter, and maybe not be so critical of their specific trades. Um, I I can be quite brash on Twitter. However, I hardly ever criticize people's trades if they lose or win, because you are playing one of the hardest things in the world, whether you're in FX, whether you're in Bitcoin, whether you're in whatever. Um, so the main thing is to maintain your edge, and to understand your edge, and to really just make sure that you can stay in the game. And the only way you can do that is by those first two things: understand your edge, and just keep plugging away at it.
Yep. I think that's incredibly useful advice for anyone listening. The one thing I want to wrap this up on before I ask for your kind of closing thoughts, and you let people know where they can get in touch with you and learn more about your newsletter, and also how to get those insights every single day, is a question I'm going to be asking all the guests now is, what's the one question or one belief or view you have about crypto that you think the most people would disagree with, whether it's your close friends, Cred and Danny and them, or you think it's, just the general belief in the crypto scene? What's the one thing that you would say that most people would say that's probably wrong?
Um, I think that you'll never see another valid ICO ever. And I think that STOs are very, very unlikely to make a real go of it, unless there is some serious infrastructure that can be built. And I know people may hate this, but regulation has to happen if you want any real serious money to come in as well. And I'm talking about from the institutions, if you want to call them that. Because they won't touch anything with a barge pole unless they're regulated, which is really ironic because they break regulations all the time. But yeah, that's my opinion, and I think it's all predicated on that initial thing. There's one entry to it, and that could be if they start using blockchain. I know UBS and Barclays have massive teams set up to start using blockchain. I know that Commerce Bank have just done an OTC trade or a couple of OTC trades using blockchain. So this could be the first foray into it, and the first requirement for regulators to step up to the plate and really introduce concrete black and white text on what crypto regulations could be. But until then, I don't think we'll see a valid SEO, and ICOs are just totally dead in the water.
What do you mean about another valid ICO? I like this. I want to hear a little bit more about what you mean by that. Are you saying BitTorrent is a valid ICO?
I don't know enough about that.
Okay.
But what I do know is that 90% were absolute dog shit, and they didn't have any business case. They had a case for getting people's money with a really nice white paper and website. But when you actually knuckled down into it, there was no business case. And I do believe that ICOs were a kind of figment of the low interest rate environment that we're in, where people were just looking for yield. And it happened, in the .com, where so many crap firms got funded with no real basis behind it, and it's just a modern day repeat of that. In a lot of cases, there are obviously some fantastic firms that came out of that era, and I'm sure there are some great ICOs, but a large majority of them weren't. And that's just my opinion. Feel free, anyone, to tell me to fuck off on Twitter. I do not mind.
That's a hard argument to take the other side of. I think most people, even if they didn't agree, I think now they've participated and been burned enough to agree. The one question I have with the STO thing is, this is something that I think my opinion has changed on, and more closely aligns with what you just said. But when they were first coming out, I know that was something I was really excited about. And I know it's not revolutionary, it's more evolutionary. It probably didn't excite a lot of people that aren't as excited about things in finance. I know there's a small group of us that those kind of things are exciting. But what you mentioned is so true. There just isn't a product market fit yet. And also it's kind of a chicken and egg problem in that a lot of the STOs, in order for them to get funded, there needs to be infrastructure. And in order for the infrastructure to kind of the incentive to be there to build that infrastructure and for people to fund infrastructure projects, there has to be STO raises. And the raises that I've looked at for, real estate plays or, STO funds or whatever it is, a lot of the times they're not filling. And then they have to go to traditional metrics. And then it's, is it even make sense to be adding kind of the STO and putting things on the blockchain? So I'm glad you brought that one up too. I think I definitely agree with that one, but I'd be curious to reach out on Twitter, guys. I'm curious on what you think about David's thoughts about ICOs. Anyways, David, thank you so much for coming on. This was fun.
No worries at all.
Anyone listening, I learned a fair amount from you almost every single day, but definitely in this conversation as well, in terms of breaking down those complex macro relationships. And then also, it just so closely aligns with what I want to do and what I think other people should at least think about in terms of having a longer term approach with their trading. So I'm glad we got to hit on some of those. Before I do wrap this up, where can people get in touch with you? What's the best way? And then also, how do people get signed up for your newsletter if they even want to check it out? How do they do that? What's the best go?
Yeah, sure. So I think my Twitter's the easiest, the most accessible place, since that's where us finance heads are based most of the time, and that's at macrodesiac_. And there's on my pinned tweet, there's a link to the newsletter, and also just in my website thing, just underneath my app. So yeah, that's the easiest place.
Cool. And then for people that aren't as familiar with the newsletter, what exactly do you do every single day? Because we've talked obviously about all the stuff you do, research and communicate. What's the newsletter consist of? What's the value out there for people?
Yeah, so essentially, I it's just my ideas that I use in my own personal trading, and the way that I like to stay in touch with the narratives that I've set for my initial trades. And what I like to do is obviously provide a different angle on things, because I feel that a lot of the stuff that's out there is just boring and doesn't give you that. I keep talking about edge and trading in the tails, for example, and that is my edge. I can recognize where I believe that there's a mismatch with data and the narrative that's not currently priced into the markets. So that's what I provide to subscribers. And it's been well received so far. People have been enjoying it. I don't write in a formal fashion. I write, conversationally, and I think I just enjoy doing it. I like it, conveying my thoughts and getting replies and people interacting with it. And yeah, it's just something else for me to do, which is fun.
Good stuff. Yeah, I can tell you enjoy doing it. And I've also seen tons of people, including guys that I trade with and guys that I follow on Twitter, that have reached out and talked about how it's added to their technical plays or given them more conviction in something that they wouldn't have had conviction in. So it is definitely well received. Guys, if you do want info on that, it is linked down below. If you're watching this on YouTube, if you're watching this on iTunes, go on over to YouTube or on David's Twitter, and I'm sure you'll be able to find it right there. David, thank you so much for coming on. This was fun, man.
Cheers, Luke. Thanks a lot, mate.
Yep, cheers. So you guys made it to the end of the podcast. Thank you so much for listening all the way through. I hope that did provide a little bit of value. Like I said, David has some insights. It was fun getting to talk to him and hear what he has to say, both for crypto and for legacy markets. Let me know what you think about his last comment and really about the entire episode. Like I said, I love getting that feedback from you guys. All the links for the episode are down below. David's page, David's newsletter. And then also, I'm going to have a prize coming up pretty soon for people that do leave a rating and a comment on iTunes. I don't have it just yet. The iTunes link's down below if you'd like to listen to the audio version, but I will have something coming soon for you guys. So stay tuned for that. Until next time, continue to move slow, trade well. Peace.